Hello, everyone, and welcome out to our university education. Today's class is on growth rates. We're going to focus on company specifics, talk about revenues and earnings and some different fundamental factors. This is part of our Equity Advanced Education, and I hope you're enjoying the process. So let's remind you before we get going too far that everything we go through is intended to be educational, instructive, not to be construed as personal investment advice. First of all, we don't know your personal situation, your needs, your objectives, your age, your demographics, any of that. And also, everything that we give as far as examples are practice trades only. So go in, practice, learn how the markets work, and remember that, again, we're not financial advisors. So with that, let's jump in here and talk about growth rates. Growth rates can be applied to a lot of different things. We're going to really focus them on the financial markets, but you could think about growth rates in any aspect of your life. You could compare income. You could say, well, if I made 50,000 one year and 100,000 the next year, I had 100% growth in my income, right? And then the next year you go from 100,000 to 150, well, I had a 50% increase in my income. So growth rates refer to the percentage change of a specific variable within a specific time period. So we could compare month over month, we could compare quarter over quarter, or we could compare year over year. In the financial markets, year over year is very common, but quarter over quarter or every 3 months is also common as well. Kind of looking at the trajectory of a company, how it's doing. And for investors, growth rates represent the compounded annual rate of growth of usually one of two factors are most commonly cited: revenues, that's the total amount of money coming into the company, or earnings, which is the total amount of profitability. And we'll talk about each of those. Revenues are often called sales. So revenue is the money coming in. Revenue growth is the increase or decrease in a company's sales between two periods. So obviously, if we were looking at investing in a company, we would want their sales to grow stronger and stronger. A lot of investors will look at revenues more than other factors because what they're interested in looking at is not the earnings, because earnings can be kind of tweaked. You could cut expenses to generate earnings in the short term. You can do some things, but sales come from one thing, and that's customers. So revenues really tell us a story about whether the company is getting bigger and better or shrinking and losing customers. Revenue is very important, vital to businesses. So, an example of revenue growth would be if we took a company like XYZ and we said, well, in the year of 2020, they brought in a total amount of revenue of $50 million. That's a small company compared to what we'll look at here in a minute, but I just wanted a simple example. In 2021, maybe for the entire year, they generate revenue of 75 million, assuming the year was done at the end of the year, 75 million. Or these could be any year, right? This could be 2019 to 2020 or whatever. But the point is their revenue increased by 25 million. So what's the calculation? Well, it's a pretty simple growth calculation. You take the increase or decrease and divide it by the prior number. In other words, we had an increase of 25, and if we divide that by 50, which was the starting point, we can see that revenue increased by 50%. 25 divided by the 50 number, in other words, the increase number divided by the prior number will give you the growth in this case. Now, what if, hypothetically, we had a situation where the company lost money? It would be a different calculation. Let's say that the growth was actually a decline. In other words, instead of increase, it was a decrease. So what they would call revenue growth would be negative, actually. Let's say you went from 50 million to 40 million. Okay, so what's the decrease? What is the revenue growth? Well, you lost 10 divided by the prior number of 50, and now we know it's a negative that we're going to put in front of that. But 10 divided by 50 is 20%. right? So it's a negative 20% growth. It's a negative number, and companies will do that. Does every company generate the same amount of revenue every year? Of course not. They're always changing, and it can be getting better, meaning your revenues are going up, or it can be getting worse, meaning your revenues are going down. And so when we look at revenue numbers, we can see positives in some companies, we can see negatives in some companies. This is a big part of fundamental analysis of business in terms of looking at that trajectory and saying, okay, how are these numbers shaping up and what do they mean? Let's look at earnings, which works very similar. What's the difference between revenue and earnings? Well, revenue tell us how much total money is coming in, how much the customers bought, and we can add all that up, right? They bought $50 million worth of stuff. That amount of revenue came into the company. But that doesn't tell us how much the company actually earned. Earnings are a different number, and that's profitability. How much profit did you have? Well, in order to figure out your profit, you have to subtract all the expenses. Just because the company brought in 50 million does not mean that they had 50 million in profit. Far from it. Every company pays expenses. We have to hire employees. We, have ongoing expenses as far as anything else, turning the lights on, well, that costs money. Heating, air conditioning, that costs money. Paying accountants, that costs money, right? So there's expenses within a business. So if we had revenue of 50 million, hypothetically, and our expenses came out to 40 million, well, what's the actual earnings number? The actual earnings is, well, revenue minus expenses equals your total earnings. And in this case, the company had 10 million in earnings, right? And there's a couple of important factors here in terms of the earnings. Can companies be a good investment and be losing money? Now think about that for a second. Could a company be losing money and still be a great investment? Well, the answer is a resounding yes, because if the revenues keep growing and growing, let's say that this is a company, a lot of growth companies lose money because they're still expanding out their empire, right? So you look at a company like Amazon or whoever, Amazon was willing to lose money in certain segments to gain market share. Whether you agree with what Amazon did or not, it's kind of the monopolistic, if I'm a big company and I can come in and slash prices, I can survive longer than the smaller guys. And so I can hurt my competition enough to where they go away, and then I have the market, right? And then I can raise prices. Now, I'm not saying that Amazon necessarily did that in all of its segments, but that's kind of one aspect of it. The other is just maybe they're willing to lose money in something that they feel like has huge growth potential. I mean, if you're looking at space companies, if you're investing in some company that's going to take trips to Mars and so on, they don't have any real earnings right now because they're just spending money. But what they're saying is wow, how much would somebody pay for a trip to the moon or something? Probably not a trip to Mars, but let's say that we started taking people to the moon. How much would they pay for that? What type of revenue could we bring in? So in some ways, companies have future potential that investors are paying for. And it's almost like you wouldn't care if a company was losing money if you thought that at the end of the whole thing there was just this huge revenue opportunity. Would you care if a company were losing 10 million per year if there's billions and billions of dollars of profitability out there in the future? And so whether you agree with those companies or not, I'm not advocating for one versus another. I'm just telling you why investors might pay for a company that's losing money, that only really has expenses right now, but they might be willing to do that because they think the revenue potential and, frankly, the earnings potential of the future is dramatic. Earnings growth is the increase or decrease in the company's total profit. Now, when companies report earnings, they do it on an EPS, earnings per share. So when you look up an earnings number, you could look up the total net income, the total amount of profit, but the easiest way is to look up the EPS. They'll report it as, well, for every share we have out there, we made $2 of earnings or $3 of earnings. They'll report it on an EPS. So anytime you see EPS, that stands for earnings per share, and it's an easy way to do this earnings calculation. If company XYZ had earnings per share of $2, so they made $2 of profit per share out in the market, and then the next year they made $3 per share of profit, they had 50% earnings growth. What was the growth? $1 divided by the prior number of 2, that's 50%. What if the company earned 2 and then the next year only earned $1.50? Well, then we'd have to do the calculation. The difference between the two numbers is 50 cents. We divide that 50-cent difference by the prior number of 2. 50 cents divided by the $2 from the prior number gives us, in this case, the negative earnings growth, right? It'll come out to a number, and then we know it's negative because it went in the wrong direction. In this case, it's 25%. Is what that number comes out to, and it's a negative. So if the earnings go from $2 down to $1.50, they lost 25% or 1/4 of their earnings. And you can see that instinctively, right? If we go from $2 to $1.50, we lost a quarter. We lost 1/4 or 25% of our earnings. So it could be a positive, it could be a negative number. Now let's go live in the markets and discuss a little bit more about these numbers. One of the websites that I like to use is called Google Finance. It's very simple. You go to Google, type in Google Finance, comes right up, click on the button, and we can come in here and do some research. We can type in any stock that we want to do research on and start to find their numbers, because if they're publicly traded, they have to report their numbers every quarter, once every 3 months. So these numbers are constantly updated to tell us how the company's doing, and revenues and earnings are two big factors. They're the two factors that people watch the most because it gives so much information about the business. So let's just pick a stock. Let's say, whatever, Twitter's right here. Okay, great. Let's just choose Twitter. So if I go into Twitter's business, as I click on that, I can come down here to their financial performance. It defaults to quarterly. That's showing quarter over quarter. So see, this is the fourth quarter of 2019, first quarter of 2020, second quarter, third quarter, fourth quarter. So it has it broken down by quarter. You can see quarterly numbers. You can see that from late 2019 into the second quarter of 2020, we had two numbers, revenue and earnings or net income, and they were both kind of going down, right? The revenue was the green. Revenue number, they were still bringing in a lot of revenue, just shy of 1 billion per quarter, right? They hit $1 billion here, but then the next quarter it went down to a lower number, and the quarter after that it went down. But then it started to rebound, increased. You can see the last quarter, big increase in revenue. If we look at the income or kind of earning side of it, it troughed in the second quarter of 2020. That was a big loss for the company. They lost money, almost over $1 billion quarterly loss, and then increase from there. What was significant about second quarter 2020? Well, of course, that was COVID, right? COVID decimated. You'll see a lot of numbers that got hit during that time period. And so when they reported their earnings, not stellar, but then it's rebounded since then. Or you can look at it on an annualized basis. And you can say, okay, what do we like? What do we dislike? Well, in the case of Twitter, the revenues have really been increasing. They're bringing in more and more money, aren't they? you can see the revenue of 2020 was 3.72 billion, which was higher than probably the 3.3 or whatever in 2019. And this was 3 billion here, and this was just over 2, maybe 2.5 and 2.5 there. So the revenues have been increasing. Now, the earnings have been going in the right direction. They were losing money, they lost less, they made money, they made even more money. Last year was a different scenario where they lost money, but again, I think a lot of that had to do with the COVID situation and was very specific to that. So if these revenues keep going in that direction, I would certainly be confident to say that the earnings are going to turn right back around and be profitable. If that revenue growth continues, this looks like kind of a one-off number, and then the earnings will start to increase back up. And oh, by the way, the stock, of course, let's look at it over the past 5 years. You can see that the general trajectory has been higher for the most part, kind of bottomed in the second quarter of 2020 when it was at its worst, and has been increasing from there. Very importantly, those revenue numbers have been increasing, and I think the profitability will probably show that as well. When you look at different companies, you'll see that each company's different, right? If we let's look at an airline. Airlines were, obviously very hard hit from the situation. So look at the second quarter and third quarter 2020. Remember, we're back to quarterly numbers. Look at how their revenue just got decimated. I mean, the revenue in the second quarter was so far below. Nobody was flying. Nobody was flying on Delta Airlines. And so it just got decimated. And of course, the earnings, I mean, they were reporting losses and taking big losses because they had a lot of expenses and not much money coming in. They had to go out and take out loans in the bond market and borrow money to kind of get through this rough patch. So the question is, okay, well, where's it going to go from here? You'll see it in the annual numbers. We were on this great trajectory for both revenue, the green, and earnings. Earnings were climbing, steadily, and then hammered in 2020. Revenue more than cut in half. Earnings, of course, huge drop. So as an investor, you're kind of looking at this as making projections. Well, where do I think the revenue is going to go back to? What is it going to do in 2021? Do I think it'll be more, less than, or equal to 2020? Well, the first half of 2021, probably pretty tough. Not a lot of people flying so far, but in 2021, these vaccines are now kicking in. We're getting millions of people vaccinated. The back half, I think there will be pent-up demand and a lot of travel and so on. So I would expect the revenue to kind of kick up just a little bit from 2020, and certainly the income, the profitability to start to recover. I don't know if they'll report a profit this year, but the expectations would be that maybe they can start to bounce back. So as an investor, you're making certain analysis as far as what you expect these things to do. If you look at some kind of high flying, I mentioned space companies. These are very popular. If we look at something like Virgin Galactic, well, if I go into Virgin Galactic, there's no earnings, they're losing money quarter over quarter over quarter. And look at the revenue. The revenue is basically non-existent. Again, this is a company that's just trying to build out for the future. I mean, they don't have any customers right now. Their revenue in the fourth quarter of 2020 was literally zero. They brought in zero money as far as, sales. They're not selling anything yet. And so as you look at the annual numbers, the profitability is non-existent and the revenue is just almost non-existent as well, right? There's not really customers out there. So this is a bet on the future and what the future might look like and these space flights and so on. And they're spending a lot of money, hundreds of millions of dollars, to try to build a viable business that can go into outer space and do all these sorts of things. So it's a very speculative investment on the future. Now, if in the future these revenue numbers become very large, an investment could pay off. But as an investor, you got to kind of look at things from the standpoint of, okay, what's my risk? What's my reward? What's my value? You have to have a good entry point in order to make a real speculative investment. If you think that you're paying a sky high price, obviously that's not ideal. And you can just brainstorm through any of these. You can see a lot of the large cap tech names. Something like Microsoft skirted through 2020 pretty well. Let's just go to their annual number. See, in 2020, more people bought Microsoft products than ever before. Large cap tech was not really hit by COVID because people were still buying phones and buying, Excel and buying all these things. In fact, they were stuck at home. They might have bought more electronics, more technology, more of this. A lot of companies were basically going away from the office and setting people up at home, and so there was expense costs with that. And so notice that the revenue numbers have been increasing year over year over year, and earnings have done a pretty good job of increasing as well. They made almost 50 billion in profits and net income. In fact, if you look down here at yellow, it's at 44.2 billion in profit on 143 billion in revenue. That tells you they spent almost 100 billion in expenses, but they made, a nice profit there. And the year over year change, see the growth rates that we were talking about? They give you the growth rate right here. Their revenue grew by 13%. This green bar is 13% above that one. Their income grew by 12.8. This is 12.8% higher than that number. So as you click on these and you see these year over year percentage changes and so on, that's what it's telling you. It's giving you the details here of what they have. There's your earnings per share, okay, increased by 13.8%. So you start to see those numbers, and anything that has some real numbers to it, you can start to get that. So the last one we'll talk about is GameStop. GameStop is in the news a lot lately. Whoops. Let's try that again. GME, GameStop. And this stock has become quite the story. If you're watching this video in the future, you might not know the GameStop story, but you can go back and look. This was a stock that was a $4 stock. It's ramped up, now trades in the hundreds as of right now. Who knows what the future holds, but here's been the problem for them fundamentally. Fundamentally, they topped out with over $2 billion in revenue here and have dropped down, and you can see their revenue has stalled out at $1 billion per year. Their earnings, of course, they've been losing money the last couple of years. So the question is, can GameStop reinvent themselves and become an online technology business and so on? And even if they can, what price should you pay for an investment in that stock? This one has become dislocated probably more from the fundamentals and more of a focus on just the trading side. And that will happen from time to time. There's these, Reddit movements and these things that are kind of pushing the stock. So as an investor, you want to go in with your eyes wide open. You want to say, okay, revenue is down here, earnings is down here. This company is going to have a major turnaround in order for that stock to be a good long-term investment. And at these prices, seems very, very expensive given the fundamentals. A lot of things, a whole lot of things will have to go right in order for that company, to flourish in the future. Doesn't mean it can't happen. And certainly this movement into the stock and all these things can help the company because they could do different things to raise more capital, to try and reinvent themselves. But it's going to be interesting to see in the future how that goes. You can see that just year over year, if we look at the annual number, the revenue declined by 22%. So if we go to the annual number from 2019 to 2020, big drop. Net income, it says rose by 30% because they didn't lose as much in 2020 as they had lost in 2019. So Interesting to see if these revenues year over year, we were on the quarterly, but here's the annual revenue. They brought in 6.47 billion in 2020. Will that increase, decrease, or stay the same in the future? And what will the stock do in terms of that? Hope you've enjoyed this class on growth rates, learned a little bit more about the fundamentals. I've enjoyed it as always. We'll see you next time. Goodbye, everyone.